So I'm going to tell you how to improve your chances of getting a mortgage. Now, this is relevant for people who may be buying their first home, so they're getting their first mortgage, but also people who may have a mortgage already that may be looking to remortgage. Now, you have to remember that if you've got a mortgage already, one option that's always open to you is a product transfer. So you can stay with your same provider. When your mortgage deal ends, you can switch to another, for example, fixed term deal with that same provider, but you have to accept you're going to have less choice in terms of deals and the interest rates that are available. But on a positive, there will be less onerous checks, so they won't necessarily check your income like they do when you take out a mortgage with a provider for the very first time. So with the idea that you might be taking out your first mortgage or remortgaging, what should you be doing in the lead up to trying to get a mortgage? Now, you should be doing some of this stuff as far in advance as a year ahead of when you're planning to apply for a mortgage. So the first thing I want you to do is check your credit report. So you should be checking your credit report with the three main agencies out there. So Experian, Equifax and TransUnion. The reason why I say you need to check with all three agencies is because they can hold different information about your financial arrangements. Also, different mortgage lenders will check with different agencies when it comes to looking at your credit report, and they use that information to create a credit score and decide whether they're going to lend to you. Now, the information on there needs to be accurate. So when you look at the report with each agency, make sure the information is correct. If there are any errors at all on there, then do make sure that you contact the credit agency and you tell them that there are errors so they can be rectified. Now, the problem is it can take a while for any errors to be rectified. So that's why you need to do this way ahead of planning to take out a mortgage or remortgaging. Now, the other thing you want to check is whether there are any financial associations. They will show on your credit report. Now, that is where, for example, you may have had a joint account with an old partner, and that means that your credit reports are linked, and that can adversely impact your ability to get a mortgage if, for example, they have a very bad credit report. So you need to close those accounts if it's a joint account and make sure you contact the rating agency and tell them that you are no longer financially associated. Also, do make sure you're registered to vote. The reason you do that is positive for your credit scoring when you actually apply to a lender, but it is also used as evidence that you live where you say you do. So make sure that you're on the electoral roll. If you don't know, contact your local council. The other thing you've got to make sure you do is pay all your bills on time. Make sure you don't miss any payments because they will show up negatively on any credit report. So that can have an adverse effect if you are trying to apply for a mortgage. If you've missed payments, say on a utility bill, or it could be on another product that you've taken out. Now, missed payments are bad. They can negatively impact your credit report and any credit scoring, but defaults are worse. So if you have something like a loan, for example, and you've defaulted on it, then that is particularly negative when it comes to a lender looking at your credit report and trying to judge whether to lend you money. A county court judgment is even more severe than a default. So you don't want to have any county court judgments on your credit report. So that means that if, for example, you get parking tickets, make sure you pay them, because if you don't, then you could end up having a CCJ for something like not paying your parking tickets. They are all treated the same. So make sure you don't have anything like that on your credit report. Next, make sure you are managing your existing debt correctly. So first of all, make sure your debt levels are nowhere near your income levels. So when you go to take out a mortgage, lenders will look at something called a debt to income ratio. And it's an important metric when you do apply for a mortgage, and it compares your total monthly debt payments to your gross monthly income. Now, this ratio helps lenders assess your ability to manage monthly payments. So they will calculate that by adding up all of the monthly debt payments, which include credit card payments, loans, and even potential mortgage payments. And they divide this by your gross monthly income and multiply it by 100 to give you that percentage. Now, if your monthly debt payments are, for example, £1,500 and your gross income is £4,000, that will give you a debt to income ratio of 37.5%. Now, what lenders do is characterize you by the level of that DTI, that debt to income ratio. So if it's over 50%, then you're considered a high risk borrower, and that will mean you'll probably need to use a specialist mortgage lender. If you're between 30% and 50%, then that's acceptable to a moderate risk, and you'll generally be eligible for most standard mortgages. But if you are less than 30%, then you are deemed a good borrower, and you're likely to be approved for most mortgages out there by most lenders, and you'll probably receive the best rate as well. So you want to maintain a good debt to income ratio. So make sure you calculate what that is. And if you have to, then pay down any debt with savings that you have. Now that leads on quite nicely to something called credit utilization. You need to know what your credit utilization is, and that is the percentage of your potential debt you've got access to that you are using. So if, for example, you have credit cards that give you a total of £10,000 when it comes to available credit, and you've got a balance of £5,000 on those credit cards, then you've got a credit utilization of 50%. Now, lenders prefer you to have a credit utilization of less than 50%. So maybe aim for something like 30%. So the message is avoid using all of your available credit if you're looking to get a mortgage in the future. Now, there'll be some of you that have old credit cards that you're not using that are effectively inactive, but there is available credit on them. And you might be thinking, well, should I just close them down then? Now, you have to be careful with what you do, because old accounts, whether it's a current account or a credit card, they are actually positive for your credit report because it shows you've had a relationship with a lender or bank for an extended period of time. I understand that people have inactive credit cards and they worry that someone might get hold of the details and spend on that card. That is obviously a valid concern. So you need to keep an eye on these accounts even if you're not using them. But do be careful, because if you close them, not only could you be getting rid of an old account that could be positive for your credit report, but you could change your credit utilization. So if you closed all of your available credit lines down to your level of credit you're using, just your one credit card, then you are actually increasing your credit utilization ratio. So that can be negative. So be careful of that. The other thing I want to mention, car finance. So car finance eats away at your monthly income. It can be a sizable chunk, a few £100s. When you go and apply for a mortgage, they will assess your outgoings. And obviously your car repayments will form a sizable chunk of that. And that could limit the amount of money that they will lend to you. So what's better to do is to own a car outright, so you don't have any loan payments or finance payments going out for that car that can count against you when you apply for a mortgage. So that means that maybe you do need a new car, but you're looking to maybe take out a mortgage in the coming year. Maybe see if you can keep the old car going for that bit longer. And then once you've got your mortgage, then you might look to take out a new car, maybe via car finance, once you've secured the mortgage. Next, avoid opening up new lines of credit, especially in the months ahead of getting a mortgage. And that's because that can negatively impact your credit scoring with a new lender. So there will be hard searches done on your credit report, which will show up, and that could negatively impact your chances of getting a mortgage. I would also say it's not just about taking out, say, credit cards. It's also if you take out bank accounts. So if you take out a bank account that's got an associated overdraft, then the bank could do a hard credit search on you, which will show on your credit report. So I mention that because I know there are lots of people who like to switch current accounts to take advantage of incentives. Maybe hold off doing that in the lead up to trying to apply for a mortgage or remortgaging. This tip is slightly unusual because it's actually to do with social media. Now, you've got to realise that our lives are online, so be careful what you post, because lenders do potentially have the ability to go and look at what you're posting online to show you what your lifestyle is doing, or maybe some of the things you're doing in terms of if it's tax evasion. Anything that's a risk could negatively harm you when you're trying to apply for a mortgage. The other thing, you might have friends who think it's absolutely hilarious to put references in payments when they send you money, or you might be doing it to other people. Avoid doing that, because when they look at your online bank account, they will ask for statements, for example, when you apply for a mortgage. So they look at your discretionary spending and they see these strange payments. They might start to raise questions. It might just slow down your application. While we're talking about spending, do stay out of your overdraft. So a lender will look unkindly on somebody who keeps going into their overdraft each month and then comes back out of it when they get paid. It shows you're not managing debt very well. And given that they're going to lend you even more money, they could see that as a potential risk. Now, the other thing I want you to do is look at your direct debits and standing orders on your account. So you want to keep all financial commitments down. Go and look at your online banking, list all your direct debits and standing orders, and see if there are things on there that you can get rid of. Because when you apply for a mortgage, the lender will ask to see your bank statements and what you're spending your money on, because they use that to assess how much income have you really got to service the mortgage that you want to take out. So you want to get rid of unnecessary direct debits. If you can afford to, try to pay for services annually rather than monthly, because that removes that commitment. So whether it's something like Disney Plus or insurances, paying annually is cheaper, but when it comes to insurances, it also removes that element of credit agreement that actually exists when you're taking out an insurance policy with a provider. Because when you take out insurance, if you take it out annually, they will only do a soft check on your credit file. But if you take out a monthly policy, so you're paying premiums monthly, they'll actually do a hard credit search on your credit file. It will show on there for when the lender looks at it. So if you can, try and readjust your finances so you have very few direct debits and payments going out. The lender won't look for a whole year's worth of bank statements. They'll look for about 3 months worth. Now, obviously, once you've done that cleanup, you have to bear in mind that lenders can still make a judgment call for an assessment about how much you might be paying for certain things that aren't necessarily showing in your personal finances. So you can't get rid of everything and say to the lender, look, I'm not spending any money, because they are realistic. They will know what people generally spend on certain things, and they can factor that into your own mortgage application. Next, which is kind of obvious, if you are going to be taking out a mortgage for the first time, then you want to save as much as you can for a deposit, because that will mean that you will get the best deals and you'll get the lower rate. So if you've got a high loan to value, you tend to pay more interest than somebody who's got a low loan to value. So the bigger the deposit, the better the deal that you normally get. And so if you are somebody who's remortgaging, then you might want to consider overpaying your mortgage ahead of a remortgage if you want to change lenders. So that normally means there are limits. So you can normally only pay 10% a year of the balance of your mortgage without incurring a penalty, but it's something to think about. People ask about pensions. Well, workplace pension contributions don't tend to have an impact when it comes to the assessment for a mortgage. But if you are self-employed, for example, and you are paying into a private pension, then that can impact affordability. Talking of employment, staying in the same job can be positive when it comes to applying for a mortgage, because they want to see reliable sources of income. So a history of employment is positive. That doesn't mean if you are going to change jobs ahead of an application is necessarily going to be a negative thing, but they will write to your employer and ask for evidence that you have got a job there, because they will usually ask for the last 3 to 6 months worth of pay slips. So this means you need to make sure you've got those when you're going to apply for a mortgage. Now, some lenders, like I said, will accept job contracts if you've got a new job and you started in the last few months. So it's not necessarily bad if you switch jobs, but do bear that in mind. But the main thing is, do keep a reliable history of any earnings that you have. So that's pay slips, that's also things like P60s, but also bank statements, because you want to show that the money going in your bank account is the same as what it says on your pay slip. For self-employed people, it's a little bit more complicated. So you're probably going to need to provide tax returns, maybe an SA 302 form, or you may even have to provide some accounts from your business. So it could be at least 2 years worth of accounts. Some lenders do accept 1 year's worth of accounts. If you are a limited company director, some lenders will use your salary and dividends from tax calculations, while others will use your salary and a share of the company's profit, so your share of the net profit, when they're looking at any assessment of whether to lend to you. So make sure that you know these figures in advance. And obviously, if you are somebody who is maybe a company director and you obviously can have a say over how much you get paid, you need to bear that in mind, because you need to have enough earnings for the last few years, for example, when you're applying for a mortgage to get the mortgage that you want, because lenders typically use something like 4 to 5 times income multiples when they're working out how much to lend you. So make sure the numbers do stack up. If you've got a side hustle, then that can be used as income in a mortgage assessment if you pay tax on it. If you don't, then obviously you can use the money for your deposit. Now, that is actually an interesting point. When it comes to evidence, you need to make sure you've got evidence of where your deposit has come from, because they will want to know where the money's come from for money laundering purposes. So make sure you've got statements and paperwork to show where it came from, if it's a gift, for example, from your parents. That leads on nicely to the next point, which is about keeping your paperwork in order. So make sure you've got pay slips, make sure you've got the relevant bank statements that go back, make sure you've got credit card bills and utility bills, which can help be used as proof of address, driving licenses, passports. All of those things will be useful when you're applying for a mortgage, and you can give them to your mortgage broker, something I'll come on to in a second. Perhaps a wider point, it's a good time to build a budget and sticking to it, because then you can ensure that your finances are in the best shape when a lender looks at them. So you manage your discretionary spending. Probably the biggest tip I can give you is to make sure you speak to a mortgage advisor early. So a mortgage advisor can help you get the very best deals out there when it comes to a mortgage. Not all mortgage deals are available direct to customers, so they could help you get a better deal, but they can also help you get accepted on a mortgage. So if, for example, a lender was being a little bit difficult, they can speak to that lender and give further evidence in your favour. So I would say to people, particularly if your circumstances are a little bit unusual, maybe you're self-employed, there's nothing wrong with speaking to a mortgage broker a year ahead of time. So go and see that mortgage advisor, and they can tell you how your finances are shaping up. What are your chances of getting a mortgage? What size mortgage you could get? Now, if you don't know a mortgage advisor that you trust, then there's a link in the notes of this show where you can find a reputable mortgage advisor, and actually you can get a mortgage review. The other thing a mortgage advisor will do is actually give you a wide range of options and discuss all of the different types of mortgages that exist out there and which one could be the best one for you. Not only can mortgage advisors tell you about the things you might need to change in your circumstances to increase your chances of getting a mortgage, but they can also tell you about changes in trends that are going on in the mortgage market, about what lenders are looking for. So things do change over time, so you can make sure that you are getting your finances in the right order for when you do eventually apply. And perhaps the final point I just want to mention is don't lie. The worst thing you can do is lie on an application, because not only is that fraud, but if you're talking to a mortgage advisor and you don't give them all the information that they need, they're on your side, then you will end up finding you could get rejected, and you don't want to get needlessly rejected. You apply for a mortgage and you get turned down, there will be a hard credit check on your report. So you want to limit the number of applications you are making. So be truthful with your mortgage advisor, because they can help you. Don't need to keep applying. If you do get rejected for a mortgage, then you need to look at why. And if you've got a mortgage advisor, they can explain to you why you got rejected and then can find better alternatives. Or it could be, for example, the lender's made a mistake and they can go back and argue your case.